Hi, Daria. Can't hear you. Unmute.
What's up?
Hi, Ina. How you doing?
Hi.
Doing good, thank you.
The man from Maui, right?
Yeah, that's me.
How come you're standing sideways, though? You're perpendicular to the floor.
I got my phone flipped this way so it can rest up and I can hear you clearly.
Oh, okay. All right. Well, whatever we need to do, right, Daria? Okay. I guess. All right. We'll get someone else here, maybe. What time? We're just about 12, huh? Okay. We might as well get going here, Daria. Hina. We're going to go into chapter 3 and chapter 4. Okay. We did something with chapter 3 the last time, and chapter 4 is where we're supposed to be in the course. So we'll get a good meeting here, I hope. And we will start with this PowerPoint that I hope to share with you in one moment. Here we go, share. Giving me a hard time. Doesn't want me to share. I had this problem the other day, and then we figured it out. I thought we'd solve this. Hold on. Hold on. I'm so sorry, guys. Give me a moment here. This is awful. New share. Here are all my PowerPoints. They're right here. Oh, maybe this is the problem, I hope. Share. Oh, thank goodness. Do we see the word revenues on top of that page?
I can see on my Zoom class,
Do you see it? Do you see a PowerPoint slide?
No, it is only the launch meeting button for the Zoom class.
Okay, hold on. I think I know what I did wrong here. Okay, all right. I'm going to try something. Guys, if this kicks us out, would you promise me you'll get right back into the meeting?
Yep.
Okay. I'm not sure if this is going to work. Here goes. Here goes. New share. Okay. Wish me luck.
Good luck.
Still there, huh? Okay, that might be a good sign. Here we go. Come on now. Come on. Up. Oops. Oh, man. I don't know why this thing is acting up all of a sudden. Never have a problem. Did that work? You still don't see the word revenues? You're still looking at that launch screen or something?
Yep.
No? Because I'm looking at it. Hold on. Oh. This is not that hard. I mean, this has been working no problem. We don't need that. We don't need that. This is what we want. We want this one here. And we're going to share it. Share. Still nothing? God almighty. Oh, no. Come on. I think we got it now. Hold on. You've heard me say that before, though, right?
No, we're good. I can see it now.
Oh, you can see it now? Revenues?
Yep.
Okay, you don't want to know what the problem was. I'll give you a hint. It was user error. Okay, I'm so sorry. All right, here we go. Let's have an efficient 45 minutes or so here. Okay, chapter 1 was a real brief introduction into the world of accounting. It talked about career opportunities and Gap and FASB and a few mnemonics you need to know. Chapter 3, when we went into that, we did transactions using the words plus and minus, up and down. We put $1,000 into our business. We said we increased cash and equity increased as well. So that meant our accounting equation was in balance. We bought supplies. We said supplies were increased and accounts payable were increased and we're in balance. Now we're going to get into the proper terms of debits and credits. And I don't know if you have any chance to work on any of these yet, but we're going to go over these in pretty good detail, okay? A T account is your friend. A T account is your friend. A T account mimics, it's meant to look like the general ledger, okay? A T account. It's really a piece of scrap paper used to organize the data, but that's how it's organized in your general ledger. So let's start. Debit credit. All it means is left and right. Debit on the left, credit on the right. There's no other meaning, left and right. It doesn't mean up, it doesn't mean down, it doesn't mean increase, decrease. It's not a value judgment. One's not better than the other. We just need to learn the rules of 6 items here. DR for debit, CR for credit, okay? Take a look at cash. If you have your book in front of you, look at the back cover. The back cover, and you're going to see your chart of accounts there. You're going to see all of the accounts in your chart of accounts. You're going to have a folder like this, a T account, if you will, for each of those items. So cash is always probably the first one, huh? Cash. Every T account has an increase side and a decrease side. Some accounts increase with a debit, others with a credit. And this is the hard part to start to understand, and it's always a tough nut to get through. But we have some good help for you. A T account. Let's see one with some numbers, huh? Here's your general ledger. Here's your general ledger for cash. Let's see what we have here. Well, starting on the upper left, it looks like this person put $2,000 into the cash account. Let's assume that's to get the business started. They put 2,000 in, and then maybe a day later, they put another 500 in. In the meantime, they bought equipment or something. Maybe they paid the rent, they bought an insurance policy, they bought supplies. All these transactions took place during the month. And then at the end of the month, they had a balance of $370. So let's take a look at this. You find the balance by footing. Footing means adding. You add the debit column and you add the credit column, and the high man wins. Okay? So you're looking at cash, and cash is an asset. And your first rule is assets have a debit balance. Assets have a debit balance. Assets have what's called a normal debit balance, meaning the side, left or right, which increases the number. So if you increase cash, you're going to do it with a debit. And by normal balance, we mean at the end of the period or at any point in time, this account in your general ledger should have a debit balance. If it doesn't, you've made a mistake, something's misposted, or you're playing the float the check game, which we don't really want to do, or you got robbed, something like that. So describe the effects. Okay, debit account. Blah, 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 blah. We know this. Okay, so here's your first look. Assets. Take a look at this. We just discussed it and demonstrated it. Assets are increased with a debit. So as we go further along in the course, we're not going to say, what did this journal entry do to cash? I'd like to get you in the habit of saying it debited it. It increased it. Cash goes up with a debit and thus goes down with a credit. Up with a debit, down with a credit. You remember our accounting equation? Assets equal liabilities plus capital. If assets have a normal debit balance, then liabilities would logically have to have a credit normal balance. And the same thing with owner's capital or equity. So take a look at the liability accounts. They are increased with a credit. So if we had a transaction where we bought some supplies on account, the asset supplies would go up with a debit. And since it's in accounts payable, the accounts payable would go up with a credit. Debits have to equal credits. We know that. The accounting equation has to remain in balance. And every single entry must have at least one debit and one credit. You can have more. You can have one debit and 100 credits, as long as that one debit equals those credits. Take a look at owner's capital, equity. Same thing. Liabilities are increased with a credit. We want to see a credit balance. We really want to see a credit balance in owner's capital. If it was a debit balance and it was an accurate debit balance and it can roll into a debit balance, that means technically the company's insolvent. They're out of business. They have no equity. And the only way they're going to get out of that is if someone bails them out, someone willing to loan them money, huh? So assets, debit, liabilities, capital, credit. And now we really just have two more things to worry about here. Revenues and expenses, your sales, your gains. Revenues, credit balance, revenues, credit balance. Expenses have a normal debit balance. And that's pretty much just about the whole world of debits and credits. Drawings, which you should know by now, is a contra equity account. So it's an equity account, but it has a debit balance, and they're just presenting that one there. But we're not going to do anything with drawing after the first couple chapters. So what are we talking about? 5 things. Assets have a debit balance, normal, which means liabilities and equity or capital. Revenues, credit, expenses, debit. Can I ask you to write this sentence down, please? You have a pencil there, guys? Here is the sentence I'm going to tell you to write down. After eating dinner, let's read comics. And draw a vertical line separating the first 3 words, after dinner. Guess what I gave you? A little way of maybe memorizing. Assets, expenses, drawing. So over AED, you could write debit if you want, with a plus sign if that helps. And then let's read comics, liability, revenues, capital. Over those 3, I would write credit plus. Some students like that kind of thing, some don't. When I took the CPA exam, wow, it's almost 50 years ago. The course I took was filled with those kinds of things, and I got to rely on them. Okay, so that was a brief look at debits and credits. I trust you can read this. If you can't read these little words, let me know. Okay, I think we're okay. All right. What they're showing you here is the accounting equation, huh? Assets equal liabilities plus owner's equity. Assets go up with a debit, which means liabilities and equity go up with a credit, and revenues credit, expenses debit. And then the one outlier here, this is an equity account that goes up with a debit. It's a contra. So there's not much more we can do in terms of this little portion here, other than you start doing some journal entries, some T accounts. It'll fall in. It'll be like you'll know it like your last name or your first name too, right? Okay. Here's another little grid that might be very helpful in your book. Wow, you see these three columns here? You only need to look at one of these three columns and you're okay. For example, if you know this side, the increases, you automatically know the decreases, right? If you know the decreases, you automatically know the increases. I might suggest you look at the last column, the normal balance. Assets equal liabilities plus equity. So debits have to equal credits. So we know those two are the opposite of the asset. There's your revenue credit, your expenses debit, and the drawing, which is the outlier. Okay. You'd be surprised how tricky this can be when you start doing the problems and you kind of forget until it comes clear. Come on now, I want to change the screen here. Okay, now we're going to do a few things using T accounts, okay? We're using T accounts to look at some transactions. What do we have? First they're going through the stuff about the steps. I'm not going to spend too much time here, but it sounds trite, but what happened? Make sure you understand what happened. Even if you don't know the first thing about accounting, what happened? The electric bill came today. What happened? It's payday. And once you understand what happened, you can identify the accounts involved, and you could figure to yourself which get debited and credited. And again, they're showing you more tips here on debits and credits. Mitchell Williams, the owner, invested $5,000 in his business. And that might sound familiar because they're repeating the same transactions, I believe, as in chapter 2 when we were working in the world of increase, decrease. So what happened here? Well, they're telling you he invested money in a new business. Well, we know that's going to mean cash is going to be debited. Capital is going to be credited because they're both going to go up. They're both going to increase. So we're going to debit cash and credit Mitchell Williams capital. There it is. There's your general ledger. There's your general ledger. Your cash is 5,000. Your assets total 5,000, and your liabilities and equity total 5,000. You are in balance. Any questions, anybody at this point? Okay. I'll go on. Now this guy bought a motor scooter for 2,000 cash. That's what happened. He bought some equipment, they're calling it, delivery equipment. Well, we know these are both assets, huh? Let's see now. Well, he brought in the equipment, so that has to be debited. And the cash obviously went out the door. Cash had been reduced with a credit. So let's take a look. Here is transaction B. He purchased delivery equipment and he paid cash for it. So we still have $5,000 in assets. All we did was exchange one asset for another, and nothing has changed here. We are still in balance. You can never go out of balance. Here's the example I made a couple of screens ago. He purchased delivery equipment but this time he bought it on account. What does on account mean? It means on account and nobody had money. As soon as you see that those two words, bought on account or sold on account, you know that accounts payable or accounts receivable is going to go up. So here, it looks like he bought it, so we're going to debit delivery equipment and credit accounts payable. So let's take a look at your general ledger here. We now have 3,800 in delivery equipment. 2,000 was paid with cash. This was on account. The guy trusted us to pay him. He's trusting us to pay him. And here's your credit to 1,800. Debit, delivery expense, credit payables, and guess what? We are still in balance. That accounting equation can never go out of balance. Well, we paid 18, we bought that last one for 1,800. It looks like we're going to make a payment now. We're going to make a payment. What happened? They tell you. They say it in the book, first thing. Know what happened? What happened? We're going to pay for part of that motor scooter. We're going to debit cash. Excuse me, see how easy it is to screw up? We're going to debit accounts payable to reduce it, and we're going to credit cash to reduce cash. Here we go. Let's start with our debit. Accounts payable. When we bought this on account, we owed this guy $1,800. Now, it might be a few days later, a week later, we don't know. And now he's paid down part of this balance. So now we only owe $1,200. And we had to do it with cash. We're in balance, okay? Look at your cash. You had a beginning balance of 3 minus the 6. They're showing you the balance in the account. Accounts payable, 1,800. You debit it, balance, credit, balance. And they have a few more here. Delivery fees earned, delivery revenues earned in cash. Well, do we remember that revenues have a credit balance? If we do, we're pretty good. What happened? We delivered, pizzas or something. Okay, so we got cash from people. So we know cash is going to go up, and so will our sales or revenues or what they're calling delivery fees. We're going to debit cash, credit delivery fees. Debit cash for $2,100, and way over here on the revenues, we're going to credit the revenues. The reason they're showing the drawing expenses, revenues, and delivery fees under owner's equity is because at month end, all of this information is going to get zeroed out into equity. So our accounting equation is in bueno shape. We paid the rent. That's what happened. That's not too tough. That's an expense. It's an expense. We're going to debit and expense rent and credit cash. Yeah, $1,000. Let's start with the debit. Here, now we have our first expense. Rent expense is $1,000. We credit cash, and now the cash is down to $3,500, it looks like, huh? If the month ended now, we'd have a profit of $1,100, right? Sales were 21 minus the 1,000. Same thing, paid the phone bill. This company calls it phone expense. Some companies call it telephone expense. Some companies call it communications expense. Utility, okay, they call it phone expense. Paid cash. Start with the debit. We recorded another expense. We recorded another expense with a debit that increased that. And we're spending another $100. And now our balance is down to $3,400. $3,400. Here we go. We delivered more pizzas for $2,400, but the deal is on account. On account, nobody had money. Well, we made the delivery, so we're the ones who are going to collect the money, so we know it's accounts receivable. Accounts receivable. That's going up with a debit. Delivery fees go up with a credit. Here is our debit to accounts receivable. And there is our credit to revenues. Looks like this person has a pretty profitable business going, huh, so far? He had to buy some supplies. Supplies, when you see the word supplies in our class, it's an asset. It's a prepaid asset. I wish they would call it prepaid supplies, but they don't. Okay, they bought some supplies for cash. So we now have a new asset called supplies. Debit, credit, cash. Excuse me one moment here. Got a little bit of cold. Okay. And again, we haven't been looking at our equation, but we're still in balance down here. We're still in balance. Okay. Remember those pizzas we just delivered on account? Now some of the people are paying us. Some of the people are paying us. It was good that we trusted them. They're willing to pay us. So we debit cash and we credit accounts receivable. This is not a revenue transaction. The revenue was recorded when we delivered the pizzas. That's when we debited accounts receivable and recorded the revenue. That could have been 2 months ago. Now, all we're doing now is we're getting paid. This guy paid us $1,800. We or $1,900. I'm sorry. We debit cash. We credit accounts receivable. Another exchange of assets. Couple more here. Here's a good one. We bought an asset on credit, but also had to make a partial payment, a down payment, I suppose, huh? So let's see what we have here. Mitch bought a third motor scooter for $1,000 and he paid $300 down. So say hello to your first 3-line journal entry. 3-line journal entry. We know we brought a $1,000 piece of equipment into our business, so that's a debit. We're going to credit cash for the 300, which decreases it, and we're going to increase accounts payable with the balance, the 700. So here we go. He bought another motor scooter. He paid 300 in cash. There's your credit, and there's your 700 accounts payable. Okay. Once you have the debits and credits down in your head, these transactions, should roll pretty good. Let's see. Mitch bought an 8-month insurance policy and he paid it in advance. I don't know if I should say something silly, but all insurance policies are paid in advance. You don't wait until you have an accident and then buy the insurance, right? So anyway, he paid for it in advance. And it is an asset called prepaid insurance. Prepaid insurance. Come on, I'm trying to get this thing down. There we go. Prepaid insurance, an asset went up, and we gave up another asset, cash, for that prepaid insurance. Paid the payroll. We got to pay these people who are on these motor scooters all over town, huh? Well, we know we're going to pay them in cash, and we're going to call it wages expense. Debit wage expense, credit cash. Debit wage expense, credit cash. Okay. Deliveries made for cash and credit. Okay, so this is the reciprocal of where we made a down payment on the scooter. Here, our guys went out and they delivered pizzas all over town last night, and the revenues totaled $3,500, but only $900 was in cash. The rest was a big party on campus here. $2,600 and they trust the school to pay it later, right? So we know what happened. We sold pizza. So what happened here? Our cash went up, and so did our accounts receivable. And we now know they go up with a normal balance debit. The credit is the revenue. We'll start with the debit. There we go. We got 900. And then we got 2,600 in accounts receivable, which we're going to collect in the future. And the total of those two is your $3,500 revenue. Revenue. Okay, withdrawals. Withdrawals. This is really something you see in a real tiny small business. I mean, Bill Gates doesn't walk out of his office at Microsoft and say, give me $300 to go on vacation. This is where the owner comes out. You should know this, but this is where the owner comes out to the accounting people, says to her, excuse me, Daria, would you please give me a check for $3,000, make it out to me? And you say, yeah, sure, boss. What's it for? And I tell you, I'm taking my wife on vacation in Las Vegas for a week. As soon as you hear that, you know it's a personal item. A personal item is called a drawing and has to reduce your equity, and it does. So we know we're going to credit cash, and we know we need to debit equity, but we're not going to debit that account called equity. We're going to debit the contra account. So here we go. You took the 3,000 out. It was a personal item. It was a personal item for me. I'm on my way to Las Vegas. Drawing. You debited drawing. Debited drawing. Notice you didn't debit owner's equity. We don't do that at this point. We debit the drawing. We want to keep track of the drawing separate right now. So let's see what we have here. Hold on. I'm going quickly for a reason. Okay. All right. You see these balances here? Looks like we're done for the month with this part. Cash had a balance of 470, accounts receivable 3,100. Now the month is ended. Now we're getting ready to do some financial work here, some statements, huh? We are first going to prepare what's called the trial balance. And I'm going to talk like we've not seen the trial balance before. The trial balance is simply all of those balances we now have in those T accounts listed in two columns, debit, credit. It's just a list of everything in your chart of accounts, debit, credit. And all the trial balance does at this point is tell us that we are in agreement that debits are the same as credits. Debits equal credits is what I'm saying. And you prepare it at month end typically because you need the trial balance to start doing your adjustments in financial statements. So you go to your general ledger and you pull out your different balances. And the only thing this thing does is prove the accounting equation is in balance. It's not a formal statement. It's just a worksheet. Only the accountant guy's going to see it, the accounting lady. And it's a very important tool in preparing the financial statements. No investor says, okay, I just saw your income statement. I just saw your balance sheet. Now show me your trial balance. It's not going to happen. It doesn't work that way. Nobody cares. The trial balance is listed in this order: assets, liabilities, equity, revenue, expenses. Ta-da! There's our trial balance. Where did we get these numbers? You remember the 470, the 3,100, the 80, and the 700? They came from here. From here. Look, we'll go to the bottom. Your expenses. I see wages, 1,650, phone, 100. Looks like we have three expenses: rent, phone, and wages. You'll find those on the bottom: rent, phone, and wages. So here's your trial balance. It's just a piece of worksheet proving the debits equal credits, but you're going to see shortly how important it is in terms of preparing the financial statements. And I'm going to give you the big Bob tip here, okay? You see where it says delivery phase? Get in the habit of going to that line, your first sales line, and drawing a horizontal line. The reason for that, do you know why I'm doing that, Daria? No? The reason I'm doing, the reason I'm doing it is everything above that line is your balance sheet. Everything below it is your income statement, okay? Good thing to know. So let's see what we have here. Here is the trial balance, and now they're breaking it out into different colors, huh? I guess assets are blue, liabilities yellow, whatever the heck that color is. And then we have drawing. And now here's your revenues and here's your expenses. You draw a line right under the drawing or right on top of the first revenue line. Here's your income statement. You can look at this real quick and say, wow, we had 8,000 in sales, but we only had 1,000. So we made some money. We know that already just from looking at this thing. So here we go. We prepared the trial balance. Now it's time to prepare the financial statements. And the financial statements must be done in the order you see here. You must do the income statement first in order to do the equity statement, which is second, and only then can you do the balance sheet. So let's see what we're talking about. Again, I draw your attention to delivery fees. There's your revenues, there's your expenses. So there's your income statement. It's that easy. Your revenue was this. You had 3 expenses, which they're itemizing here, and then they're totaling. That minus that gives you a profit of $57.20. That's your income, your net income. This guy did pretty good, huh? He earned like almost 70, looks like he owned 65% or so on sales. I'm going to bring your attention to the headers. This is very important. Notice that the income statement says 4-month ended. That's important, 4-month ended. You could also say month of. You could say June 2020. Same thing with the equity statement for month end. Balance sheet is different. You have to show a hard date, and I'm going to go over that in a moment. So why did we do the income statement first? Because we can't do the equity statement until we get the income. The equity statement. So let's look at this here. Well, the equity statement is going to be your beginning balance plus your income minus dividends equals ending. You have to bide your time. You know that expression, bide your time, B-I-D-E, another one of my mnemonics, huh? You have a beginning balance, which happens to be 0, and now he's invested money. He's invested the 5,000. I would even call the 5,000 the beginning number. So there's your B. He now has income of $52.50, huge income on only $8,000. But as we know, he took a trip to Las Vegas, personal debt, not debt, personal spending. So the change in equity is this number, and your new equity is $7,250. We started off with 5,000. We made income, and then we took 3 out. Here we go, 2,250. I'm hoping you're getting the feel a little bit of how it relates to the trial balance, because everything here is driven from the final trial balance. Now we know what the capital number is. The balance sheet becomes maybe the easiest one to do, because all we're going to do with the balance sheet is copy all of the liabilities, all of the assets, all of the liabilities, in this case 1. The only number we're not going to copy is the 5. How come we're not going to copy that? The reason we're not going to copy that is because it's no longer $5,000. It's now $7,250. You bring it down, and now you're balanced. The balance sheet is pretty much the accounting equation. Assets equal liabilities plus equity. The reason you have to put a hard date here, typically it says something like balance sheet as of a certain date. The reason is the balance sheet is a photograph. It is a snapshot. It is a point in time. Cash, that's how much cash we had in the cash checkbook at the end of the month. This is how much people owed us on exactly that date. These are not accumulating numbers. They don't go up, 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 up. They go up and down, up and down, up and down. So we're only going to count a period of time. What did we have at the end of the month? These numbers here, income statement and owner's equity, they're like a movie. They're like a video. It continues on and on. You start with zero by definition at the beginning of the month, and it increases, it increases, it increases. And then at the end of the month, what you have is a total for that entire month. It's a subtle little difference, but very crucial to understand. Come on now. That's the end of slideshow 1. Are you ready to get into chapter 4? Yeah, we are. So let me get chapter 4 going, all right? Chapter 4. Chapter 4. Playing games again. Okay, I think I know what I need to do. Here we go. You see chapter 4, everybody? All right. I see the sea of people out there. The number of people who've joined here. Okay. I'm going to make this a little bit bigger for my eyes. Ta-da! Okay. Now, chapter 3, we learned the debits and the credits. And we even learned how to prepare a simple financial statement, set of financial statements from that. Now, let's see the debits and credits in action in what's called journal entries. General journal, as your book calls it. Okay? I just need to move something out of my way. Get out of my way here. Over there. Okay. First of all, they talk a little bit in the first few slides. We'll go through it quick. They're going to talk about what are called source documents. Normally, when there's a transaction, there's a piece of paper involved with it. For example, you got the phone bill. You look at the phone bill, you say, yeah, that looks right, and you record it, and you prepare a journal entry, and you're probably going to take that phone bill and staple it to a hard copy of the journal entry, and into a binder it goes. Source documents. It can be anything from an email from the boss telling you to do something. It could be a bill from somebody. It could be the time cards that your employees punch in. So what they're saying here, they're just giving us a little bit of flow. Throughout the month, you're doing what we just did in chapter 3, right? Transactions are happening. Chapter 3. Now we have to take those transactions and put them in the form of a journal entry, a general journal. Everything we do in this course, we're using journal entries. The journal entry is the mechanism for updating the general ledger. The general ledger, the books of the company, if you've ever heard that, the general ledger. This is the absolute guts of the company. And once we have all the journal entries done, like we just did earlier, we can now prepare the trial balance. And from that, we can do the financial statements. So let's talk about source documents. I don't think we need to talk much about that. Cash register receipts, any piece of paper is a source document. Any communication via email, text. The chart of accounts. The chart of accounts. We talked somewhat about this. Remember, You look in the back of your book and you'll see a super big chart of accounts. Here is what we've got so far. Our chart of accounts is listed always in the sequence of assets, liabilities, equity, revenues, expenses. Notice they're saying assets begin with a 1, liability. That's pretty typical. That's what I always saw. Assets begin with a 1, liabilities 2, etc. When you get out in the working world, if you're doing this type of thing, you might see a 3-digit preface. For example, you might see cash 101, but then you might see a dot after that, 101 dot Santa Barbara Bank and Trust, 101 dot, another code, 101.300 representing another bank. So you get multiples of these. The key thing, they go in order of your financial presentation. Journalized transactions. A journal, like I said, that's the transaction itself. That's when you go into your computer system, whether it's QuickBooks or Mass 90 or Oracle, whatever else is out there these days, and you go in there and you've got that telephone bill in your hand, right? And you look at it and you say it's okay. And then you go into your journal entry screen and you tell the computer, debit telephone expense, credit accounts payable. And then you hit done. At that point, you've not done really anything at all to impact the general ledger. You might go to your second journal entry. You might do 4 or 5 journal entries and you put them all down there and you enter them. At that point, you haven't done anything until you hit the button called post. So you want to be careful. You want to hit post after you're quite sure that your journal entries are correct. If you make an error and you hit post, you can never remove that error from the general ledger. It's there forever. The only thing you can do is correct it. Probably best way by reversing that journal entry with another journal entry and then putting the right one in. Okay, so journalizing, that's the discipline of getting things going, getting it ready for the general ledger. Journalizing example. Oh goodness, you ready for some more? I don't think they give us that many transactions. Hey, he opened up a business again. Wow, we're back to that. Look at your journal entry. The journal entry. You notice that it looks like a T account. We see that, everybody? I see a T account here. And that's exactly what a journal entry is meant to look like. A journal entry will have a date, which is important. And then you start with the debits if you can. Not a hard and fast rule, but you do want to start with the debits whenever you can. Then the next one is a credit. Notice, please, that we indented the credit. You see that, everybody? That's important. You have to indent the credits. If you don't do that, it's not going to be wrong, but it's going to be a lot harder for the auditors to read when they're trying to scan things rather quickly. And it will also show that you either don't know quite what you're doing or you don't care. It's a little sloppy. Okay. So Mitchell, he opened up this business. We're going to debit cash, credit capital. There's your journal entry. Same journal entry. I'm glad they added this slide. A journal entry should have a very brief description to it. A very brief description. And when I say brief, just a couple of words. If this explanation was owner's investment, that would have been sufficient. The reason you want to have a cogent, clear, precise explanation is twofold. One, obviously, is it makes it a lot easier when you go back and look at transactions from a year ago, right? You're not going to remember what this transaction necessarily was until you see the explanation. That's one reason. The other reason, though, is if you cannot very briefly describe what you're doing in this journal entry, you're probably doing something wrong, if you have to kind of justify it. Compound entry, huh? An entry with more than one debit or more than one credit. Debits come before credits. So here they're just showing you some journal entries. Journal entries. And I believe these are the same ones we just did in chapter 3. Same ones we did in chapter 3. Ah, now I can see it better than you, huh? Take a look. Journal entry. We purchased supplies for $80 cash. We debit supplies. We credit cash. In chapter 3, they were showing you in the form of a T account, a piece of scrap paper. But this is a T account. T, cash. Here we see cash 1900. That's when we sold some pizzas on account. Or here's where we got paid. I'm sorry, we got paid. So on and so. Ooh, I was so happy. With the zooming. I thought I was onto something with the zoom. I guess not, huh? And so on. Remember, we bought the prepaid insurance policy? We, on our T account, we debited 700, we credit cash, wages, etc. And then we had this compound entry. Okay. Any questions? Anything that you'd like to ask of me now? No? You don't want to tell me the New York Jets stink? They lost again? Okay, that's a different subject. Okay. Now we're going to the general ledger. The general ledger. Just like the journal entries mimic and look like a T account, so does the general ledger. General ledger is really just a pair of T accounts, which we hopefully will see soon. T account. You're going to have in your general ledger one folder, we can call it, one T account for everything in your chart of accounts. This is the complete record of the debits and credits, looking at just one account. They're arranged exactly like the chart of accounts. T accounts were introduced in chapter 3. However, businesses are more likely to use a version called the general ledger account. Keeps a running balance. Hey, look at your general ledger. This is the first time you're seeing it, huh? General ledger, huh? Well, let's see. General ledger, this is the cash page, the cash folder. So what's going to happen here is, remember those journal entries we just looked at in chapter 3? Here we go, cash. Well, our journal entry, we debited cash for $5,000. There it is. And we did it on June 1st, $5,000. And our balance in cash is now $5,000. Our next transaction, B, we spent money. We credited cash. We credit cash. And what's our new balance? $3,000. C, or D, or what's the next one? The 600. Yeah, D, I get 600. We spent more. The balance is now 2,400. You get the idea? This T account here kind of mimics this. It does mimic it. I'm sorry. It does mimic it. Here is the running balance. So your general ledger is two of these side by side, basically. Here is the transaction. Here is the running balance. And you notice you don't see any credit balances in cash. If you do, you got a problem. And I worked for companies at different times where the cash was tight and it was June 31st and the balance in the account was $2. And I had to write a check for $800. I had no choice to pay the rent to keep the building going. That temporarily drove the cash negative until we got the next day's cash to cover it. That's called floating a check, and you don't want to get into that business. All kinds of ethical rules. But do you get the sense now? how we do the journal entry. We do the journal entries, and this is the cash piece of it. At the end of this year, say, this is a big company, huh? This is a big number. This is say 470 million, just to be dramatic. 470,000, a big number. The auditor is going to come in at the end of the month, and she's going to say, "Okay, how much money you got in the bank, Daria?" And you say, "Right here, 470,000." And she'll say, "Oh yeah, show me in you. She'll say, "Show me in some detail here." The auditor will say, "What's this 1,900?" And you're going to go to your journal entry, and you're going to look at the journal entry, which will have the explanation. So this is the balance at the end of the month. This is where the auditors will begin. It's called auditing inside out. You start with the big number, the control account it's called, and then go through all of the audit details. Posting to the general ledger, huh? We have learned how to write those journal entries. So now we've done this part. We entered the date, we entered the debit and credit and the balance, enter the journal posting. This posting reference here can be whatever the company wants to make it, okay? What they're showing you here is the chart of accounts number, the account number. Remember we said cash begins with 101. That's what you'd show on your general journal, your journal entry if you want. Don't have to, but they're showing that. And then they're showing you in the general ledger, it's coming over here. And here's the key, J1. J1 is simply a code that you can make up for yourself, or QuickBooks will provide it, or your computer will just provide it. It means that if you did, say, 5 journal entries in one batch and posted all 5 at one time, those journal entries would show J1, indicating that you did it in that particular batch. That's all. Okay. General journal entry brings that 5,000. Now you have a balance. Hey, we're back to the trial balance. Here we go. Boy, that looks familiar, huh? The trial balance. What are we going to do with it now? Well, we're not going to go over this too much. How do we explain? How to find incorrect errors. We don't make errors here, even though the trial balance, I don't even think I talked about this much. The trial balance only tells us that the numbers balance, meaning debits equal credits. Every number on that trial balance could be wrong and require adjustment. Or we made some kind of mistake. And they just give you a couple of tips here. This divide by 2 stuff. I'm not going to really get into this. The one I will show you, though, is one that I actually used for a long time, and people still use it, okay? I'm not going to worry about a slide error. Transposition error is kind of interesting, though. Maybe you know this, maybe you don't. You have a calculator in front of you guys? Here's what we're going to do. Take 963 and subtract 936. You got 27, I believe, right? 963 minus 936. We agree? You notice that number is divisible by 9? Anytime you transpose 2 numbers, the difference between the two is divisible by 9. Now, you're probably saying to yourself, well, who the heck cares? Well, who could care about that? Well, believe me, it comes in handy sometimes if you know that little rule. Back in the day when we had to do this in pencil, it was hell back in the 60s, right? You would add up a big, long trial balance, and then the debits didn't equal the credits. Oh, geez, what are we going to do? Well, one of the first things you did was subtract the total debits from the total credits. If the difference was divisible by 9, it was probably a transposition error, which made it much easier to search for the truth. I like those transposition errors. I'm not going to worry about the slide errors, which is basically the same thing. And then guess what? Double check. if that doesn't work. You can never erase. You can never erase anything from the general ledger. It's a permanent thing. A good friend of mine many years ago when we were working together, I don't know how he did this, but he meant to type in $1,000 and he ended up typing in 1 million by mistake and he posted it by mistake. Caught the mistake right away and he reversed it. But my point is, forever and ever, anyone who looked at that month, they saw plus 1,000, 1 million, and minus 1 million. It stood out like a sore thumb. And every time the auditors came in, they beat the heck out of the poor guy because they wanted to triple check it. Correcting method, I'm not going to go over that. We've just finished 2 slides. You want to go into slides 5, 6, 7, and 8 now, or you think we did enough for one day? We're good. What do you think, Anna?
I think we're good.
Any questions?
Yeah, actually, I have a question. I tried to join the tutoring call yesterday, but it was asking me for a code, and I couldn't find the code anywhere.
Well, you should be able to just go in through Canvas. It'll hook you right up.
Yeah, that's what I was trying to do, but every time I would try to join, it said put in the session passcode to join it, so I couldn't I didn't know what the code was.
That's too bad because we had a pretty good session with a few people last night. Okay.
Yeah, I was hoping to get in, but it's all good. I'm hoping that it's something on my end so I can fix it, and it's not.
Yeah, I mean they give you the link, of course, and also in Canvas they give you the meeting number and the meeting ID, so that should have helped you.
Yeah, but I don't know what the issue is, I guess.
Okay, all right, we'll see what happens then, huh?
In our mail, you can see go into Canvas and we have inbox from accounting 110 and we have message and we have meeting ID and passcode also.
Okay. Oh, there we go.
Thank you, Daria. Yeah, it's all there. Usually the problem with these Zoom meetings is me trying to get the slides going and everything. Any questions, Daria? Anything scare you?
I think not yet.
All right. Well, we're ready to end the meeting.
Yep, we're all good.
Okay. Aloha to you, right, honey?
Aloha to you too.
And das vidanya to Daria. Okay.
Okay.
Hey, we'll see you guys. Bye-bye.
Thank you. Have a good one.
Daria, don't report me to the Russian embassy, whatever you do. Bye-bye.